For years, Florida represented one of the most powerful housing booms in modern U.S. history. It wasn't just strong, it was explosive. Buyers flooded into the state from across the country, drawn by warm weather, lower taxes, and the promise of a better cost of living. Cities like Miami, Tampa, Orlando, and Cape Coral became magnets for relocation, and the demand for housing surged at a pace that completely reshaped the market. Homes were selling in days, often with multiple offers, and prices climbed at a rate that left even experienced investors surprised. It created a feeling that Florida real estate was almost unstoppable, as if the upward momentum could continue indefinitely without consequence. But markets don't move in one direction forever, and now, that long stretch of growth is beginning to show cracks. What we're seeing today is not just a slight slowdown or a temporary pause. It's a shift in the underlying structure of the market. Inventory is rising across multiple regions, price cuts are becoming more common, and homes are sitting on the market longer than they have in years. In some areas, sellers are being forced to lower expectations just to compete. And while this might seem subtle at first, these are often the earliest signs of a much larger transition. What makes this moment so important is how quickly sentiment has changed. Just a short time ago, buyers were acting out of urgency. Fear of missing out drove decisions. Today, that urgency is fading. Buyers are becoming more cautious, more selective, and in many cases they're stepping back altogether. That shift in behavior alone can dramatically alter the direction of a housing market, especially one that had been so heavily fueled by momentum. In today's video, we're going to break down exactly what's happening beneath the surface of Florida's housing market. We'll look at the economic forces driving this shift, the warning signs already appearing in the data, and the specific cities that are most vulnerable heading into 2026. Because while some areas may stabilize, others could experience much sharper declines, and understanding the difference could be critical for anyone watching this market closely. Section 2. How Florida got here. To understand where Florida is heading, you first have to understand how it reached this point. The pandemic fundamentally reshaped housing demand across the United States, but Florida was one of the biggest beneficiaries of that shift. Remote work allowed people to relocate without being tied to expensive urban centers, and Florida quickly became one of the most attractive destinations. The combination of no state income tax, relatively lower home prices compared to places like New York or California, and a desirable lifestyle created a perfect storm of demand. This influx of new residents wasn't gradual, it was rapid and intense. Entire communities saw population surges within a very short period of time, and housing supply simply couldn't keep up. Builders rushed to meet demand, but construction takes time, and during that lag, prices were pushed higher and higher. Investors also entered the market aggressively, purchasing homes to rent out or flip, further increasing competition and driving prices upward. But this kind of rapid expansion often creates imbalances. When demand grows too quickly, it can push prices beyond what local incomes can realistically support. And that's exactly what happened in many parts of Florida. Home values surged far faster than wages, creating affordability challenges that were temporarily masked by strong migration and investor activity. Now, those supporting factors are beginning to weaken. Migration into Florida is slowing compared to its peak levels, and many of the buyers who drove the boom have already made their purchases. At the same time, higher mortgage rates have significantly increased the cost of borrowing, making it much harder for new buyers to enter the market. The result is a growing gap between supply and demand, and that gap is where price corrections begin. What makes Florida's current situation unique is that multiple pressure points are hitting the market simultaneously. It's not just one factor causing a slowdown, it's several forces all moving in the same direction at the same time. First, there's affordability. Even though Florida was once seen as a more affordable alternative, many areas have become increasingly expensive. When you combine high home prices with elevated mortgage rates, monthly payments can become unsustainable for many buyers. This alone reduces demand significantly. Second, there's the surge in inventory. During the boom years, builders accelerated construction to meet demand, And now, many of those homes are hitting the market at a time when fewer buyers are available. At the same time, existing homeowners who locked in lower mortgage rates are beginning to list their properties, either due to financial pressure or changing circumstances. The result is a noticeable increase in supply across multiple regions. Third, and perhaps most uniquely to Florida, is the insurance crisis. Homeowners' insurance premiums have risen dramatically in recent years, driven by increased hurricane risk and insurance company losses. In some cases, insurance costs have doubled or tripled, adding a significant burden to home ownership. For buyers, this isn't just an added expense, it's a deterrent. It changes the total cost of owning a home in a way that many didn't anticipate. And finally, there's investor behavior. Investors were a major driving force behind Florida's housing boom, but now many are stepping back or exiting entirely. When investors leave a market, they remove a key source of demand, which can accelerate price declines, especially in areas that relied heavily on investor activity. When you combine all of these factors, you start to see why Florida's housing market is under pressure. It's not just cooling, it's being reshaped. Number 1. Cape Coral, Florida. Cape Coral is one of the clearest examples in Florida of how quickly a booming housing market can flip when the underlying drivers start to weaken. During the pandemic years, this city became a magnet for both investors and out-of-state buyers looking for affordable waterfront property. Compared to other parts of Florida, Cape Coral offered relatively lower home prices, newer construction, and the appeal of canals and coastal living. That combination created a surge in demand that pushed prices up rapidly, sometimes at unsustainable speeds. But what made Cape Coral rise so quickly is also what makes it vulnerable now. One of the biggest issues is oversupply. Builders ramped up construction aggressively during the boom, and now many of those homes are hitting the market at the same time. Instead of a shortage, there is now a growing surplus of available properties, and when buyers have more options, sellers lose leverage. That shift alone can dramatically change pricing power in a market. Another major factor is insurance. Cape Coral has been hit hard by rising insurance premiums due to hurricane exposure and flood risk. For many homeowners, insurance costs are no longer a small add-on. They're becoming a major portion of the monthly expense. For buyers, this changes the entire equation. A home that once seemed affordable may no longer make financial sense once insurance, taxes, and maintenance are fully factored in. This reduces demand even further. There's also the investor angle. During the peak years, Cape Coral saw a high level of investor activity, particularly in rental and short-term rental properties. But now, with rising costs and softening rental demand in some areas, those same investors are starting to exit. When investors begin selling, it adds even more supply to the market, accelerating downward pressure on prices. And here's where it gets even more important for retention. Cape Coral isn't just declining randomly, it's showing a pattern. Homes are sitting longer. Price reductions are increasing. And in some cases, properties that were purchased near the peak are now being relisted at lower prices just to attract interest. That's often one of the earliest signs of a market transitioning from expansion into contraction. So when you look at Cape Coral, what you're really seeing is a perfect storm. Too much supply, rising ownership costs, and weakening demand all happening at once. And historically, when those three factors align, price corrections tend to follow, and sometimes faster than people expect. Number 2. Northport and Sarasota, Florida. Northport and Sarasota tell a very similar story, but with a slightly different twist. These areas weren't just popular during the boom. They were some of the fastest-growing housing markets in the entire state. People weren't just moving here for affordability, they were moving for lifestyle. Beaches, retirement appeal, and a quieter pace of living made this region incredibly attractive, especially for retirees and remote workers. That surge in demand pushed prices higher at a rapid pace, and just like in Cape Coral, builders responded by increasing supply. New developments expanded, communities grew, and inventory started to rise. But at the time, demand was strong enough to absorb it. Now, that dynamic is changing. Demand is no longer keeping up with supply, and that imbalance is starting to show. Homes are staying on the market longer, and sellers are beginning to adjust expectations. Price cuts are becoming more common, not necessarily because sellers want to lower prices, but because they have to in order to compete. What makes Northport and Sarasota particularly interesting is the psychology of the market. These areas were heavily driven by relocation buyers, people moving from other states with higher home prices. But now, as prices in Florida have risen and affordability has declined, that advantage is shrinking. Florida is no longer as cheap as it once was, and that changes buyer behavior. There's also a demographic factor at play. Many buyers in this region are retirees or near retirees, and that group tends to be more sensitive to economic uncertainty. When markets become volatile or costs rise, they may delay purchasing decisions or reconsider altogether. That reduces demand in a way that isn't always immediately visible, but becomes very clear over time. Another key issue is inventory layering. Not only are new homes being built, but existing homeowners who bought during the boom may now be listing their properties as conditions change. This creates multiple layers of supply entering the market simultaneously, which increases competition and puts pressure on prices. So Northport and Sarasota aren't collapsing overnight, but they are transitioning. And that transition is exactly what often precedes larger corrections in housing markets that grew too quickly. Number 3. Tampa, Florida. Tampa is one of the most important markets to watch because it represents a different kind of risk. Not oversupply alone, but affordability breakdown. During the pandemic boom, Tampa saw massive price growth. It became one of the most competitive housing markets in the country, with buyers bidding aggressively and prices rising far beyond historical norms. But while prices surged, incomes didn't keep up at the same pace, and that created a widening gap between what homes cost and what local buyers could afford. Now that gap is starting to matter. With mortgage rates remaining elevated, the monthly cost of buying a home in Tampa has increased significantly. Even if prices stabilize, the cost of financing alone makes homes less accessible to buyers. And when fewer people can afford to buy, demand naturally declines. At the same time, inventory is increasing. More homes are being listed, and fewer buyers are stepping in to purchase them. This creates a shift in market balance, from a seller's market to a more neutral or even buyer-friendly environment. What's especially important in Tampa is the role of first-time buyers. This market relied heavily on entry-level buyers during the boom, but those buyers are often the most sensitive to interest rates and affordability. When they step back, it removes a major layer of demand. There's also a timing factor. Tampa's growth was relatively recent and rapid, which means many homeowners purchased at higher price levels. If prices begin to decline, some of those homeowners could find themselves in a difficult position, especially if they need to sell. And here's the key retention point. Tampa doesn't need a crash to feel like one. Even moderate price declines combined with high borrowing costs can create the perception of a much larger downturn. And perception alone can influence buyer behavior, leading to further slowdowns. Number 4. Punta Gorda, Florida. Punta Gorda is one of the most important markets to watch, not because it's the largest, but because it's already showing clear signs of decline. In many ways, it's acting as an early signal for what could happen in other parts of Florida. Home prices in this area have already dropped noticeably, and the reasons are becoming increasingly clear. Demand has softened, inventory has increased, and ownership costs, particularly insurance, have risen sharply. When all three of those factors align, price declines tend to follow quickly. What makes Punta Gorda especially interesting is how quickly sentiment has shifted. During the boom, this market benefited from spillover demand as buyers looked for more affordable alternatives to larger cities. But now, that demand is fading, and the market is adjusting. We're also seeing more price reductions in listings, which indicates that sellers are having to compete more aggressively. This isn't just about one or two properties, it's becoming a broader trend. Another factor is liquidity. Smaller markets like Punta Gorda often have less consistent demand compared to larger metro areas. That means when demand slows, the impact can be felt more quickly and more intensely. So while Punta Gorda may not get as much attention as cities like Miami or Tampa, it's providing valuable insight into how market corrections can unfold and how quickly they can accelerate. Number 5. Naples, Florida. Naples represents a completely different segment of the market, but it's just as important. This is a luxury-driven area, known for high-end homes, wealthy buyers, and strong demand during boom periods. But luxury markets often behave differently during downturns. High-end buyers tend to be more discretionary. They don't always need to buy. They choose to buy. And when economic conditions become uncertain or costs rise, they're often the first to step back. That shift in behavior can lead to slower sales and eventually price adjustments. Naples has already begun to show signs of this. Price declines have been recorded, and inventory has increased. Homes are taking longer to sell, and sellers are adjusting expectations. There's also a global factor. Luxury markets like Naples are influenced by broader economic conditions, including stock market performance and international demand. When those factors weaken, it can reduce the pool of buyers. And here's what makes this critical. Luxury markets often lead broader corrections. They tend to adjust first, and then mid-tier markets follow. Number 6. Miami, Florida. Miami is one of the most unique housing markets in the world. It's not just a local market, it's a global one. Buyers come from all over the world, bringing international capital into the city and supporting high property values. But even Miami isn't immune to market pressures. Prices have risen significantly, and in many cases, they've outpaced local incomes by a wide margin. That creates a situation where the market relies heavily on external demand. Wealthy buyers, investors, and international purchasers. If any of those groups pull back, the impact can be significant. At the same time, Miami is dealing with rising costs, including insurance, property taxes, and maintenance. These factors are making ownership more expensive, even for higher-income buyers. There's also the issue of supply. New developments continue to enter the market, adding inventory at a time when demand may not be as strong as before. So Miami becomes a balancing act, global demand versus local affordability and rising costs. And if that balance shifts, even slightly, it can lead to noticeable changes in the market. Number 7. Orlando, Florida. Orlando's housing market was heavily influenced by investors during the boom, particularly in short-term rentals and vacation properties. The city's strong tourism industry made it an attractive location for Airbnb-style investments, and many buyers entered the market with the expectation of strong rental income. But that dynamic is changing. Rental markets are becoming more competitive, and in some cases, returns are not as strong as investors initially expected. At the same time, rising costs, including insurance, maintenance, and financing, are reducing profitability. When investment returns decline, investors begin to reassess, and in many cases, they choose to sell. This creates a unique risk for Orlando. If a significant number of investors exit the market at the same time, it can lead to a sudden increase in supply. And when supply increases rapidly, prices often come under pressure. There's also a regulatory angle. Changes in short-term rental policies can impact investor behavior, adding another layer of uncertainty. So Orlando isn't just dealing with a typical housing slowdown, it's dealing with a shift in investor dynamics. And that can create volatility that isn't always present in more traditional markets. And here's the thing most people aren't paying attention to right now. This isn't just about Florida. What's happening here is a signal. A signal that one of the hottest housing markets in the country is starting to shift. And when a market that strong begins to crack, it raises a much bigger question. Where does this go next? Because historically, housing trends don't stay isolated. What starts in one region often spreads, especially when the same pressures exist across the country. Rising costs, affordability issues, and shifting demand. So the real story might not just be about Florida. It might be about what Florida is showing us before it happens somewhere else. Now think about this for a second. If inventory keeps rising, if buyers keep stepping back, and if costs like insurance and interest rates stay elevated, what does that do to prices over the next 6 to 12 months? Do they stabilize? Or do they continue to move lower? That's the part of this story that's still unfolding. And this is exactly why staying informed right now matters more than ever. Because whether you're buying, selling, investing, or just watching from the sidelines, timing in a market like this can make a massive difference. The same market that created huge gains over the past few years is now creating very different opportunities and very different risks. So I want to hear from you. What are you seeing in your area right now? Are homes sitting longer? Are prices starting to drop? Or is your market still holding strong? Drop a comment below and share what's happening where you live, because real-time insight from different areas tells a much bigger story than headlines ever could. And if you found this video helpful, make sure to like, subscribe, and turn on notifications because we're going to keep tracking this closely. The housing market in 2026 is not going to be a simple story, and the next few months could be some of the most important we've seen in years. And trust me, you're going to want to see what happens next.